Today for the Fed, it's a case of not what they do, but what they say. Eric Stein joins me. He's co-director of Global Income and a portfolio manager with Eaton Vance. Nice to see you.
Great to see you as well.
So you're not expecting the Fed to make any announcement changing interest rate policy, but what are you looking for in the statement that will come out this afternoon?
I think with the statement, they want to keep options open. If the data improves, if the data stabilizes at least, hopefully improves, I think there's a decent chance that they'll hike rates at the December meeting. If the data goes the other way and deteriorates, then they'll push rate hikes off to 2016. So I think they really want to give themselves lots of optionality in the statement.
What's holding the Fed back for now? Is it data that shows some weakness in the U.S.?
That's certainly hurt a little bit. So if you go back to the September meeting, the U.S. economy was doing pretty well, but there were more concerns with China and financial market volatility. Fast forward here to the October meeting, financial market considerations have gotten maybe a little better with the stock market running up and the dollar actually weakening a little bit as opposed to strengthening. But on the other hand, U.S. data has actually weakened since the September FOMC meeting. So they're really concerned about both.
What do you think the Fed should be talking about that perhaps they are not?
I think they should be talking about the underlying strength of the U.S. economy. How, yes, we're going to have volatility. First quarter GDP wasn't good. Second quarter GDP was very good. Looks like third quarter GDP is not going to be as good. But generally speaking, the labor market is very healthy. The economy is recovering. We're headed in the right direction.
At the same time, I know you are worried about China, for instance.
Yes, look, certainly an economy as large as China's has to have effects on all countries in the world, the U.S. Included. So it's certainly a concern, but I actually think some of the stimulus we've seen in China, they recently cut interest rates and lowered the reserve requirements. That should help keep the Chinese economy from having a so-called hard landing. That's actually net beneficial for the whole world system, including the U.S.
Are the markets going to be confused if there is such disparity between what central banks are doing around the world, not just in China, but also Europe?
I don't think so. I think headed into this year, the theme of central bank monetary policy divergence was certainly one of our themes at Eaton Vance. I think a lot of people were talking, a fair amount of people were talking about it. And so I think investors could see that. That's why you saw the dollar strength, and there was confidence behind that. And then we had the September FOMC meeting where the statement and the press conference kind of muddied the waters. Recently, we've had different FOMC members, some saying they want to raise rates, some saying they want to push it off to 2016. So I think that actually the disagreement among FOMC members is more confusing to markets than central banks going in opposite directions.
If the Fed waits till December, potentially is it too late? In other words, are they behind the curve a little bit?
I think we're getting there to be behind the curve, not in the traditional sense. Usually when people say the Fed's behind the curve, as people always like to say, it means inflation's accelerating. We're not there yet, but they may be behind the curve from the standpoint of the business cycle. The business cycle may be peaking. I don't think we're going into a recession, but maybe the business cycle is peaking. And so if it's peaking, why haven't they raised rates yet?
I'm wondering if the markets are prepared for the next couple of months and Fed policy. And what are your concerns about volatility in the markets? I mean, let's face it, we've not ever seen the Fed do this. We've seen the Fed raise rates, but not coming out of QE and zero rates, essentially.
Yeah, so look, I think actually raising rates off zero doesn't have to be the end of the world. Doesn't mean you're going to see so much volatility on that day. Now, in anticipation of that, you're going to see volatility. You've already seen volatility based on the chance of that happening going up, the chance of that happening going down. So I certainly think exiting from quantitative easing, exiting now from the zero lower bound, which is what we're talking about, it's going to be generally volatile. Whether or not it's actually volatile on the day it happens, I think remains to be seen.
And in terms of the fixed income space, what are you telling clients right now for the next couple of months, positioning ahead of December?
Yeah, I still think the credit markets are attractive. High yield and bank loans, they offer good carry. We still have solid fundamentals. Corporate balance sheets are still in very good shape. And also on the emerging market side, I think you need to be a little more selective, but that asset class has been beaten up a lot. It's actually doing somewhat better here in October. Actually, having a very good month in October, so I think there's opportunity there as well.
Eric Stein, good to see you. Thanks so much.
Thanks for having me.
I'm Rhonda Schaffler for The Street.